Everything you've been told about safe investing is a dangerous lie designed to keep you poor. You've been told to buy bonds for safety, but the data from the last 100 years tells a different, terrifying story. While you're diversifying for peace of mind, you're actually increasing your chance of financial ruin in retirement. Today, we dismantle the status quo using a century of global market data to reveal the only strategy that truly protects your future. According to the 2023 study Beyond the Status Quo, a 100% equity portfolio outperforms all traditional advice. Let's look at the ruin probability. A 100% stock portfolio has only a 7% chance of running out of money. Compare that to the so-called safe target date fund, which has a staggering 19.7% ruin rate. Yes, you heard that right. Your safe fund is nearly 3 times more likely to leave you broke. Why? Because the biggest risk isn't a market crash. It's outliving your money while inflation eats your purchasing power. Bonds return a mere 0.95% after inflation, while international stocks deliver over 7%. Over 30 years, that gap isn't just a difference in numbers. It's the difference between a legacy and poverty. To match the wealth of a 100% stock investor, a 60-40 investor needs to save 93% more money every single month. Are you prepared to work twice as hard just to settle for a riskier, safe strategy? The financial industry pushes bonds because they fear volatility. But volatility is not the same as risk. True risk is reaching age 85 and realizing your balanced portfolio can't pay for your groceries. The data shows that the more bonds you add, the more you have to save just to keep your head above water. For a TDF investor, the equivalent savings rate is 16.1% compared to just 10% for the all-equity investor. That is a 61% penalty on your hard-earned income for the illusion of safety. Let's talk about diversification. You think bonds protect you during a crisis? Think again. In the short term, they might. But over 30 years, the correlation between stocks and bonds rises significantly. When high inflation hits, both stocks and bonds can fall together, leaving you with nowhere to hide. In contrast, international stocks show almost zero correlation with inflation over the long run. They are the ultimate hedge because companies can raise prices, while bond payments are set in stone. By holding bonds, you are betting against human innovation and the growth of the global economy. The study analyzed 39 developed countries over a century. The result was unanimous. Whether in the US, Europe, or Asia, the 100% equity strategy produced more wealth and more security. It generates 50% more wealth at retirement compared to a balanced 60-40 split. And when it comes to leaving a legacy, the median bequest for all equity was 4 times higher than a TDF. So, what is the optimal allocation? It's not just buying stocks, it's strategic diversification. The winning formula, 33% domestic equity and 67% international equity. Why 67% international? Because it provides a massive shield against domestic economic downturns. International stocks deliver both growth and diversification, something bonds simply can't match. This combination minimizes the probability of a total portfolio failure while maximizing the upside. But here is the catch: you must have a stomach made of iron. To reap these rewards, you must be willing to endure a peak-to-trough drawdown of 55%. Can you watch half of your life savings disappear on paper and not click the sell button? If the answer is no, the system has already won. They want you scared. They want you in safe, low-return assets. Logic, not emotion, is your only defense against the fear of volatility. Most people will ignore this data. They will choose the comfort of the herd over the truth of the math. They will retire with less, work longer, and leave nothing behind, all while feeling safe. But you are here because you want more. You want the truth, even if it's uncomfortable. The 100% equity strategy isn't a gamble. It's a calculated bet on humanity's progress. Set your allocation. Automate your contributions. And then, do the hardest thing of all: nothing. Stop letting safety ruin your future. Trust the data, embrace the volatility, and claim your freedom. This research isn't gospel, and past performance doesn't guarantee future returns. But if you have the courage to endure the volatility, you will claim your freedom.